Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Gemma Mitchell, welcome to this episode of the Australian Finance Podcast. How you doing?
Owen Rask, thank you for having me. I'm great.
That's good. Good to see you in Melbourne.
Good to be back. It feels like forever, actually, that we've been in the studio together. It's been a hot minute.
It has, yeah. You've enjoyed the sunshine and rain of Sunshine Coast.
Yeah, mainly just rain. But yeah,
cool.
Good. It was actually beautiful here in Melbourne. It's nice to come to the sunshine.
Yeah, it is. And it's a beautiful autumn day here in Melbourne, and the trees have started to change colour, and in a few weeks it will be miserable. So there's that. But today we've got a bunch of questions. Someone wrote in and told us how to find Mortgagee Sales. So we'll go through that in a sec, because that relates to an episode we did recently, talking about how to invest if you're starting out in your 30s, how to invest for kids, offset accounts, mortgages, investing, the big kind of conundrum that people face and the trade-off there. But as always, we start with, what have you been up to?
Well, Melbourne this week, and it's a comedy festival. So I've been going to some comedy shows, which has been nice. Work-wise, on Sunday, I was in the Sunday Telegraph.
On Sunday, you were in the Sunday?
Featured in it.
So
a newspaper article. Daily Telegraph, that's right, but it was a Sunday edition. And so I had to sign up to pay $4. And then I had to, to cancel the subscription, you have to call them. You can't do it online. And I was like, what? And then I thought, it'll just be a phone number that is an automated system. It's not. You literally have to talk to someone. And he's like, why are you cancelling? And I was like, well, I just signed up because I was in it and I wanted to screenshot. And now I don't want to pay $4 a week.
Oh, that's great.
Anyway, so I was in that for an article. So there were two reporters that are married in their second marriage, and they have 5 kids between them, and they are looking at how they're going to help their kids, these 5 kids, get into houses. And so they had 2 case studies of one of the children each from each side. And they just talked to 2 professionals, so myself, and then they also spoke to Molly from Ladies Finance Club.
Ah, Molly.
Yeah, and they were just chatting about like what things they need to consider. So I was talking to them, and it's really about a warm inheritance. That's really what they're thinking. You know, should they gift the money to them, and what they should be considering.
Can you define warm inheritance? Warm
inheritance means, do they gift money to their kids to help them now instead of waiting till they pass away, and the kids get it when they're likely 50 plus is the average age for getting inheritance, when it's not when we need it, right? We need it when we're much younger. So they know that their kids need it now, and they're looking at all of the options to help them. But they need to consider their own financial position, and they're young, like they've got a long life ahead of them, these reporters. So it was a two-week part. But so that was really good. I got so much good feedback and heaps of like new followers and stuff. But I did get one, I don't know if the word's troll, but I didn't.
Okay. Just one. That's surprising.
Yeah, but I didn't cope well. So I got like hundreds of like great feedback and people reaching out and stuff, and like, oh, thanks so much, I didn't consider that. And then just the one person that was like, you didn't explain this right, and da-da-da-da-da. And I just got real, because I'm like, I just want to help people. And I'm like, I'm really sorry, but I can't put 10,000 words in an article, and they just use whatever they want. They're just going to use shorts, like snippets. She was like, well, if you're going to explain it, you need to put this. And I was like, no, that's what like the bank lender will explain, like all the terms and conditions, and like, so I got really hung up on that because, I don't take criticism well. But it's mainly just, I want people to know, and this applies with the podcast as well, like these episodes, and if you're getting information in short form, whether it be social media, the newspaper or whatever, like they're designed to give you snippets of information that tell you that there's options out there, but you need to go and get advice and research and find the finer details, because in these short form, you are never going to get all of the detail. So I think this person might have worked in like mortgages or something. So like they were like, you needed to explain all this. It was like terms and conditions. I'm like, yeah, cool. Well, next time the paper gives me 40 pages, I'm in. But yeah, anyway, so that was like a bit of a dampener on it, but I just learned
Yeah, you can't be everything to everyone, Gem.
I learned a lesson that I think you don't engage, because when you engage, she's like, it sounds like you provided them incorrect information. Now you're covering your track. I'm like, I'm just trying to explain to you, mate. And so next time I'm just not going to engage. I'm going to be like, thank you so much. Love it.
One of my old editors used to say, don't feed the trolls.
Yeah, so I afterwards I reflected and I was like, I think my replies egged them on, whereas I should have just been like, oh, thanks so much, I take that on board. Or yeah, because I do want to take stuff on board, but it gets to the point where you literally, there's some people that you're never going to be satisfied.
Yeah, I just feel like they're from like a bot farm in some other part of the world that's designed to rile you up.
I was like, these Instagram messages are more words than I was allowed to have in the whole article, mate. Anyway, so I spiraled shortly, but recovered quickly. But most of it was really great. But I thought it would be good to talk about on here, because it's just the same. Like, we can't go through all of the detail that people need to make financial decisions in these podcasts. That's why we make sure that you go and get financial advice, or you go and do your own research and things.
Yeah. It's just a shame that was the outcome, because I feel like oftentimes women get it worse than men in these types of situations. Like, not to make the conversation about that too much, but I do see that. And it's just a shame. But in general, it's just a shame. But because I used to get this all the time with investing as well. It's like sometimes we would invest and we would do well, and sometimes we wouldn't do well. And in fact, when you invest long enough, you've got a record of investments that didn't do well a mile long, right? That's just the nature of it. And I realized that you just can't be everything to everyone. Mm-hmm. And particularly not when you have tens of thousands of people or what have you. You just got to have a thick skin and just be like, okay, no worries. I just normally just go, cheers, mate, and move on. Like, literally, that's probably my response. But
I think I'm just more sensitive at the moment because the book is in publishing, and I was like, oh my God, if I can't handle this feedback or criticism, or just I guess they were challenging, then how am I going to put a book out there? So I was kind of just not thinking about this one particular thing, just more like, what have I done?
Yeah. Fair.
But it was awesome, and I got so much great feedback and stuff. So
well, I'm sorry that happened, but I think your book's going to be amazing.
Valuable lesson for me. Get a thicker skin before 27th of August.
27th of August is when the book is out. When do pre-sales happen for a book launch?
Pre-sales are already happening.
Oh, they're already happening?
Yeah.
Oh, we can put a link in the show notes.
People are sending me screenshots that when they've bought it.
Oh, really? That's so lovely.
Yeah.
There you go. Yeah. My week, I don't know if this was this week or last week. I actually didn't. I've just emerged from under a rock. But I was on the project and I was talking about Pokemon cards, and I got about 14.2 milliseconds on the show, which was great. And I was talking about how people are going absolutely nuts about Pokemon cards at the moment. It just so happened that one of the other fellows who was great that was on the segment with me, he has like a $10 million Pokemon card collection, and I've got one that's in the low tens of thousands, and I'm just like, whatever.
10 million?
10 million, yeah, legit. There has been break-ins across the country of people breaking into stores just to steal Pokemon cards. It's crazy right now. It's a jungle out there, guys. Seriously.
I'm in the wrong business.
Yeah, so he was making the case that if you have a particular Pokemon card, like say the Charizard shiny card, which is one of the base set, which I have, if you get it graded and it comes out as the best, it can be thousands, hundreds of thousands of dollars in Australia. Then if you have one that's not mint, but near mint, it drops from hundreds of thousands to 3,000. The grading is really important. So my one's not mint, obviously, that's disappointing. But when I was telling Navar, the founder of Navexa, who comes in and shares the office with us, I was like, yeah, man, the project, I'm going to look like a crazy person. Fortunately, I didn't. But
they cut out the crazy.
Yeah. I think they had something when I logged into Instagram, there was 5,000 interactions with that the project's posts, and I was just like, sweet, close Instagram. That was my reaction. So you're in there like liking and responding. I'm just like, no worries, close. But it was really interesting hearing that. And when Navarre came in, he actually brought in, and he had the 3 of the first like sets of Pokemon cards, complete collections. And he was just like, yeah, I thought this would be valuable in the future, so I put it in the drawer. And it's like, I'm almost like, mate, one of those just sold for $80,000. And then the producers at the project were asking me questions like, well, how do you find this, like the next Pokemon? And I did a lot of research into this in anticipation of that segment. And I think ultimately there's no answer to this of like what makes a great collectible, which is what this is. But I think it's where, if you think about Pokemon cards, it's like the nostalgia has kept on. Mm-hmm. So there's that old joke that like being 30 is just like being 20 except you've got money. Well, it's the same when it comes to like the nostalgia benefit. If you like Pokemon at 10 or 20, now you're 30 and you've got money and you want to relive that feeling, you go and buy some Pokemon cards, right? And you pay more than the $10 or $5 that they were originally for a packet. So you need the nostalgia to live on. But the other thing that you would want to be looking at is like who's going to buy it from you in the future. So Pokemon cards are a great one. I think another great one would be like video games and, old PlayStations or Nintendo 64s, or
I had an Atari.
Atari with the gun where they had the thing, or Game Boys, or
but are these
dolls,
fads?
Barbies.
Like, wasn't there the Beanie Babies?
Beanie Babies just blew up.
Yeah, but then it's gone, right? Could Pokemon cards be gone at any moment?
That was a great case study, and that's what they asked me about. So I went back and did some digging on this. Beanie Babies was like a late 90s, early 2000s thing. One of the things that they did is that Beanie Babies knew that it was going nuts. So what they did was they restricted supply. So they took things out of the market, like certain Beanie Babies or whatever, to then jack up the price. So they're like, oh, there's only 5 in circulation, and now there's only 3. And so everyone just goes nuts, right? But then what they did is they immediately flooded the market straight back again with more production. So they were trying to ramp the price up and then flood the market with...
So the everyday person could now afford them.
And they were willing to pay hundreds of dollars for this silly thing.
Luxury kind of item.
Yeah. Whereas you look at Pokemon cards, they're not making more of the first editions and more of that base set. So that's continued on. And it's probably the same with a bunch of different things like Yu-Gi-Oh! Or those things you watch when you're a kid. There's heaps of instances like this. I found one thing, which was an iPhone, the original iPhone, it's the 2007 model, unopened, sold for $70,000.
But why? What do you do with it?
I don't even think you could use that now. I don't think it would handle the latest software.
No, and you don't open it either because you hope it just increases in value. Like,
people love that stuff. Some dude bought a Pokemon card for like $10 million for one. Yeah, I mean, it's extreme. So don't go out and buy Pokemon cards. But what we're saying is you might have stuff lying around your house that's super valuable, and you might get a lot of money for it.
This is going to encourage people's hoarding tendencies.
If anyone was listening to this, we did not expect to talk about this, but if you are listening to this and you have one of these things, I would love to do an episode on this. Like, what are you collecting that's going to be really valuable in the future?
Yeah.
Sorry, I've got to do the warning, then we'll have this bit of feedback. Just any of the questions that we do answer on the show are strictly general in nature. We don't know your needs, goals, or objectives, so be sure to speak to a financial advisor before you act on any of the information here on any Rask podcast. You can get in contact with a financial advisor that we work with or even ourselves by heading to the Rask website or the link in your podcast player. Most importantly, however, if you do want to tell us about your collectibles or send your questions in, there is a link in your podcast player that says ask a question. If you're on YouTube, it's in the description. Select the Australian Finance Podcast, and Gemma and I will be back next week to get to the bottom of it. But there was a particular piece of feedback or a tip from Compound Investor, and they said how to find Mortgagee Sales. So you can go onto realestate.com.au and hit filters. Scroll down to keywords and type Mortgagee and then the search button. I just used it and got 35 properties. That's from Jace. So there you go. Because this was a story for people that weren't familiar. We were talking about a couple of weeks ago.
Yeah, we were talking about what one of my best investments was, and I said I bought a Mortgagee sale, and it was a really good buy, but I felt like they were really common. Like this was back in 2012 and we were both like, oh, we never see them anymore. So yeah, Jace's, the compound investor, has written in and said, this is how to find it.
So I think someone's tried to game the system completely, like all these real estate agents, and they've just put development blocks at the top of the search results as ads. But there are a bunch here, actually. There's one in South Melbourne. There's one in Wamboyne. Yeah, there's heaps, actually. Alberton. Cool. Yep. There you go. So you can get a few.
There you go. But we also did talk about in that episode, there's usually different terms and conditions and, things you need
have the money.
Yeah, to consider. So.
Okay. Get a bargain.
DD, due diligence.
There we go. Crispy Bacon
wrote
in and said, in a recent episode, we learned that Owen is about 35 years old. The same age as me, says Crispy. This got me thinking, how would Owen and Gemma begin their investing journey if they were just starting out as I am? Okay, we can speak generally about this. If we were 35 years old, cannot confirm or deny. It's a great mystery. How does one begin investing in their 30s, let's say?
Ooh. Well, it's never too late. It's absolutely never too late. I would be, if this was myself or clients, like it would be the same, right? Like I would be making sure that you had your education foundation sorted, like your day-to-day habits, like all that stuff is so important. So if you've got that sorted, and the next thing I would be doing, if this was me personally, I had nothing yet, like I'd have, this person might also have superannuation, but if I had not started an investment journey, so they've said, how do you begin your investment journey? So if I hadn't started with property, shares, anything, I honestly would probably be personally, for my situation, prioritizing trying to get into a property, and I would be investigating that. Can I borrow where I want to live, all that kind of stuff, and I would be wanting to either know that that's a possibility or rule it out and then go on to my plan B and then my plan C. So that would be my plan A, I think. Like I already have property, but I think that would still be something. But I would be investigating that completely. Could I have a house that I owned first? Go to a mortgage broker, see if I can get the borrowing potential, see if I think I can save a deposit in what time frame. Totally look at that strategy and either rule it out completely or start working towards it. And then I'd have be learning on the side about different stuff. And then my plan B would probably be, do I buy an investment property or do I start investing in shares? And that's going to be my strategy. But I honestly think for my personality, my lifestyle, I probably would be investigating a property first if I hadn't already.
Yeah, that's good. That's I think that's good knowledge there, Jem, because that was one of the big mistakes that I made when I was in my 20s and I went on this journey. But as in, I didn't prioritize property. Because I didn't realise, I didn't really think 5 years ahead of where I was. I didn't think in 5 years I want a property and shares, probably. And I didn't realise that you could have property and shares. I always just thought it was one or the other because everyone's always doing this debate, property or shares. What would you say is?
Pokémon los dos.
Pokémon los dos. There we go. Which for anyone that speaks broken Spanish.
Or watches the taco ad.
What does it mean, actually? Is it one or the other?
It means why don't we do both?
Why don't we do both? Yeah.
If I've learned anything from the El Paso ad.
Old El Paso. What a great ad. I use that analogy all the time. But, that would be great. I think that you can get an investing education really cheaply these days. What I mean by that is you can listen to podcasts like us. It's great. You can take one of our free courses. We've got free courses on investing. But also, you could start with a micro investing app. So Sharesies, I've downloaded before. Raise, I've got on my phone. Pearl Micro, sponsor of the show, FYI. Beta Shares Direct is only $10. All of these platforms are also a sponsor of the show. All of these platforms allow you to invest with under $100. CommSec Pocket, but not so much given what I'm about to say. And all of them, I think, maybe Perla doesn't do this, allow you to invest in shares and ETFs with a small amount of money. And so, for example, if you had $50 or $100, you don't need to wait until you've got 50,000 or 100,000 and be like, oh, now I'm a real investor, or, people have that like limiting belief. You can start now, learn how it works, and still save for the first home deposit or something that you're wanting to do. Because then when you go and you get your first home and then you get some equity and you redraw and you invest or you do whatever you want to do in life, you'll come away thinking, I've just had 3 years of investing experience.
Yeah.
People don't know this actually. In the Raise app, you can go in and you can build a plus portfolio, what they call a plus portfolio, and it gives you like 50 or 100 stocks. I'm pretty sure you can put like $5 into a stock where most of the micro platforms are like ETFs only. I'm pretty sure you can do stocks with that. So I would go get an investing education. I would do exactly what you just said. And the easiest way to get into a property sooner, and this is going to sound so silly, is just to earn more. And I know that's like not the news everyone wants to hear, but like maybe for the next 2 years, you can earn more. You can do something, a second job, something like that to save the deposit quicker. But also it's a secondary benefit of a higher income equals more purchasing power, which often means that you get a better property the first time. And interestingly, with that, if you're going to start a business, as I know many people that listen to this show go on to do, keep in mind you won't be able to get a loan from a bank for 2 years unless you're like the next Afterpay or something crazy. I'm sure they'll give you some money. But if you're like 99 point whatever percent of business owners, you won't be able to because they need 2 years of financials in order to approve your loan. So just keep that in mind. I think that's a great question. I can neither confirm nor deny I'm about 35. When I saw my psych, I'm pretty sure they said, geez, anyone talking to you would think that you're 50. That was good feedback.
Is that a compliment?
Yeah, I think so. I don't know, so I'm taking it. Porque no los dos, I think that's how I'm not supposed to say it, but I just did anyway. It says, hi, Owen and team. I've been a long-time listener of both the Finance and Investor podcasts, and I've heard you guys talk about the trade-off between paying off your mortgage and investing. I'm currently considering selling off poor-performing investment property. We've heard a lot of that lately, actually. And the income from the sale would just be enough to offset our home mortgage. Can you please provide some thoughts on putting it in an offset versus investing? My thinking is that as the mortgage itself decreases and amount needed for the offset will decrease too, and I can put that remaining extra amount into ETFs every year. Don't know if I said that right. Have I missed something? Is this a good strategy? Would love to hear your thoughts. Thanks, team. Love your shows. Awesome. We deal with this a lot. We get a lot of debt recyclers, and remarkably, a lot of people that listen to our podcast for a couple of years, they're just like, blow me away. How much they can save, put in their offset account, pay off their mortgages, do all that sort of stuff. This is an age-old debate. Mortgage, invest. Thoughts?
Yeah. Well, I think, they've answered their question with their name. You could potentially be doing both. And it could be, like the home loan, so putting money in the offset is helping reduce non-tax deductible debt. It could be that they reduce it and then they do a debt reduction strategy. So they reduce the non-tax deductible debt and then they use it to invest. There's lots of layers here that they need to think about, and it comes to long-term goals, how much they want to invest, surplus cash flow, but ultimately sleep at night test. Are you going to be able to meet your goals with not investing or investing? Are you going to sleep better knowing, some people are just better with no debt. Others are better with having a commitment of a debt repayment and able to save a lot better. There's so many different things that it will be different for each person. But maybe this is something that you initially start one way, you pay off your mortgage or whatever it is, and then you decide, oh, actually I'm ready to invest, and you take it out. I kind of think either way it's going to be flexible. You could probably change your strategy. I wouldn't want you to put it into shares and then in 12 months go, oh, I prefer to put it in the offset and take it out. If you're going to invest, you want it to be a 5 minimum, probably 7+ time frame.
Yeah. Yeah, great.
But I think you need to think of what's going to make you most comfortable. Tax-wise, you can make it work by debt recycling or something like that. But maybe it's you have a comfort level that I would love to have my mortgage under 100,000 or 200 or whatever your safety net is, and then you do the.
Yeah, I like it. I like that point about the safety net for what it's worth. We have a lot of clients at the moment for our financial advice that want
to pursue debt recycling strategies. We've got people that have almost in identical type scenarios where they're thinking, do I pay off completely? Do I not? Whatever. And I think it actually just comes back to goals, because the wonderful thing about having your mortgage paid off is work becomes, even if it's not fully optional, it's like mostly optional. Like you can work 2 days as opposed to 5 days or something. So maybe that's the goal, right? Like to coast, what we call coast FI. Or maybe it's, I'm going to go hard for 5 or 10 years. I'm going to use this debt recycling thing that they talk about, and I'm going to boost my investment portfolio. And so at the end, I've got an investment portfolio and I've got my mortgage paid off. Or it's none of those things. One of the things that's interesting as well from this, if I think about goal setting and whatever, is they started with an investment property that they said is poorly performing, which is coming across very often nowadays because of land taxes, interest rates, just the general gist, which I've talked about a lot.
There's 2 ways it could be poor performing though. Is that capital, or is that from a cash flow holding perspective?
Yeah, maybe they're over leveraged, maybe they bought a poor asset.
It might be poor performing from cash flow, but there might be a great opportunity to hold on to it for capital growth.
Yeah. What I think about it though, right, is once people understand the power of what you talked about before as tax, like as deductible debt, once they understand that they can use their own home as, like they can recycle the money from a traditional offset or mortgage into like a redrawn mortgage and then invest that for a tax deduction on the interest. Once they understand that, then they go, oh, so you're saying like, I don't need to buy like a second or third investment property. I can just use this on one property and it'll be simpler. It's like, yeah. And I'll get franking credits on the shares dividends. Yeah.
Yeah.
And it's just like eye-open.
Yeah.
And that's where it's like, if you sit, I'm not saying everyone needs to see a financial advisor, but in this instance, if you're going to pursue something that seems a little bit riskier, they'll be able to say to you, if this happens, then that would do that. Based on your goal, this is the optimal outcome. The reason why a lot of people don't do that is they're more familiar with property than they are with shares. So they kind of don't feel it's safe, which is fine.
And they're very different assets. But if you're trying to get your head around them and you get the concept of property and you feel comfortable with property, then you can kind of like, they're not the same, but compare it to, so share like dividends and returns, the income that you get from shares, think of that like rent. And capital growth on a share is just like capital growth from there. Tax deductibility, like your negative gearing, it's kind of like the tax deductibility of a loan. Like they have very similar qualities that, transfer between the assets, but the actual asset class and the risk are very different.
Yeah. So they did answer their own question, but Gem's probably, I dare say, in the camp of, you could do that and then you could limit your exposure if you did go down an alternate path. It all comes down to your goals. Like I'm pursuing an equity release strategy, which is similar but different, but I think ultimately it depends on your goal. If your goal is 10 years growth, maximum amount of money, that's going to be different to if it's I'm new to investing in shares and ETFs and I've got a 3-year time horizon. Very different. So just think about that goal. And then there's an option to fit. There's a tool or a strategy to fit the goal. Bill Breaking says, is it possible to, where possible, have all big expenses like car rego, insurance, etc., to come out, to all come in at the same time of the year, or spread these across the year? What strategies work best for most people? I guess this will vary depending on the situation, etc. But is there any research or anecdotes around this? So Bill Breaking is talking effectively about trying to consolidate the debt repayments into one period of time, I'm assuming, so that then they can have the other part of the year to build up a cash surplus or something like that. What I can say is that many of the big bills now are best paid a year in advance. So things like car insurance.
To get the discount.
Get a discount because they do offer you a discount. But some things like car rego, depending on your state, like in the state of Victoria here, they offer quarterly registration. You don't have to pay the full thing up front, which then may be able to help someone time some of the payments that they want around. So you may be able to mix and match, so to speak. But like a very cliche example is Amazon Prime often, and Disney do the same thing, often offer you 30% off if you pay for a year ahead of time.
Yeah. And if you're doing that with all of them, like you're generally with insurance, don't quote me, but if you pay annually, you pay like 12 months worth. If you pay monthly, you end up paying the equivalent of 13 months or something like that. So if you think of all the household bills, if you're getting that extra percent, it's actually going to add up. But not many households are in a position that they can just be outlaying these.
Yeah,
and
it's a lot of money.
potentially you'll get to that point if like you start working on that now and you start building up a regular bills account. You can easily get to that, but most households can't just go, oh, we're going to start paying annual straight away. Like
Yeah, we'll just pay a car, insurance,
it takes time.
this, that. Yeah, it's a lot.
Yeah. I think the issue with this is they're saying, can they align all of their big expenses? Probably not, because your rego and all of that, it's just when they become due. It'd be pretty hard. If I was this person and I had a lump sum that if I had 10 grand sitting there that I could pay all my bills at once in one hit, that'd be amazing. I would just put it in a bills account and sit it there and know that whenever they come up, I'm ready to pay them. And I would work out my 12 months of expenses, not including that 10 grand in this example, whatever it is to you. And I would just start putting the next 12 months away, not including the buffer that I just put in. Yeah,
it's a system for your money, as you always say.
Yeah, but that's would be an amazing position to be in. If you're not in that position, which, he might not be, I would calculate when things come up and see, maybe you've got 3 months to your car rego comes up. So what is that each month till then? Maybe you've got 12 months to the other thing. That's a complicated way of doing it. But if you're a detailed person and love a spreadsheet, that's probably the most accurate way. Or if you're like me, I just lump everything as 12 months and just start putting it away and hope for the best that they're going to come out at different times. But if you could start it with a buffer, that would be great.
Yeah, that's what I always used to think of it as, like a float. It's kind of like a lot of people get down on themselves when
the
budgeting.
sinking fund,
They we're like, okay, 1st of May, budget, this is happening, we're doing it. 2nd of May, car rego is due. Oh my God, my budget. And they're just like, I had to pull money from that, budgeting.
And then it doesn't work.
Yeah. But if you have that little buffer, and that's why we say, some of us would say, if you have multiple credit cards, you maybe don't want to cut them all up on day one because you may have to consolidate, you may have to move things around, and your budget might not be perfect on day one, but it's a process that you'll work through. And obviously, if you have the luxury, as Gem said, have that float sitting off to the side so it can keep, you can handle those lumpy things, and then you just top that up until the next year rolls around and so on and so forth. But that system of the money is so important.
And you just have to be patient and go, well, yes, I didn't change it all and it wasn't perfect overnight, but if you keep at it, at least in 6 months or 12 months, you're going to be in a completely different position than you are right now. If you just go stuff it didn't work, you're going to be in the same position. What would you prefer? Slow progress is better than no progress.
Absolutely it is. Yeah, it's great. It was interesting because on our new cash flow spreadsheet thing, that we've been giving to the financial advice clients. That was really interesting because you could have a budget where most people have something like this where it's got it's in a spreadsheet or something, and it's got this is a monthly bill, this is a yearly bill, this is every quarter, and then the spreadsheet multiplies depending on whether it's monthly or 3 months or a year.
Yeah, just does it for you.
Yeah, and then it smooths it out for you so you can understand what you need to do each and every week or month or whatever. Final question comes from Daddy New Money. They say, listening to your show has inspired me to take the plunge into the world of investing. That's wonderful. I've set up a monthly automated investment into some ETFs through BetaShares Direct, disclosure sponsor of the show. I am wanting to set up accounts for my 2 children, 9 months and 2 years, to give them a head start in adulthood. What platforms offer these types of accounts? Thank you both. Keep up the great work. Well, we do appreciate this, Daddy New Money. We won't make a recommendation per se. We will give you general wisdom about investing for kids. And frankly, I think it's great that you're investing for kids because why not? It's a great catalyst to get you compounding for the long term and to help them buy a house, go to uni, do all those types of things. Ultimately, I think a lot of new parents overcomplicate this. I think you get hung up on those weird tax rules that you see on the ATO website. You get worried about which investments do I pick, which provider do I use. The good thing about investing for kids is oftentimes it's smaller amounts of money, which means you can change. It often means too that the tax isn't super damaging until way later in life. And thirdly, sometimes you don't need to invest quote unquote for the kids. You can invest in your name, your partner's name, or something like that, and then later on in life gift them the investments. So there are many different options. I can speak to this directly, Gem, and then I'll ask for you to share your 2 cents. I am in the process of setting up an account for young Charlie It'll just be a Rask Invest Jupiter account, or the new one, which is coming soon, or a Lunar account probably, which is all growth. Ultimately, most people want something to grow, and the biggest consideration is whose tax file number do you put down. And that can have implication of who pays tax now and who pays tax when the transfer of shares or ETFs takes place later on in life. I would say most platforms offer these. They call them minors or kids accounts. The name varies. Some platforms have minimum balances depending on what you're looking for, but a lot of brokers don't. Yeah, we've got a guide from this, by the way.
Oh, great. I'll put it in the show notes.
Yeah, what do you think? Do you invest for kids?
I do, but I have a family trust structure. If I didn't have all of that already set up. So it purely because that's already done.
Because you're a financial advisor.
Oh, yeah, and I just make stuff as complicated as possible.
Yep.
So that structure is already all set up. But prior to all that changing, my kids, we were always invested just in my husband's name, not even in trust for them, because it was kind of before that was done with platforms. That's kind of only a new thing, I think.
Yeah, last 10 years probably.
Yeah, so they've had a share fund each since they were born.
Yeah.
Actually, I just found out a couple of days ago, I went to get a bank card for my daughter's youth saver account. They're like, she doesn't have one. And I was like, oh, second child, forgotten the bank account. But she has a share fund. So we always just decided that it was going to be invested in the lower income earners' name. If it could have been in their name in trust for, so it could be transferred, it would have been. But now I've got this complicated structure, so it's just in there.
So with the family trust, you said, so this is where people get confused. When you have something in trust for, that's different to a family trust.
That's very different. Yeah.
Family trust costs like $4,000 for people listening to set up.
There's a lot of ongoing fees.
Yeah, there's annual accounting and stuff. Whereas in trust for is basically the way the actual brokerage account or something is named effectively. And it means that you're holding shares in trust for a child.
Yeah, because they're under 18 and they can't legally hold shares, and it means that at 18 they can transfer to them without having to be sold and having potentially a capital gain. They can just become that person's. If you're investing for the kids but you're not sure if they will go to the kids, it's more like, we'd love to be investing and we hope this goes to the kids, but, if anything, the share fund for the kids is substantial now. But if something happened family-wise, that's family money. It's earmarked for them, and we talk about it with them and they put money into it. But it's free game, kids.
Sorry about that.
But yeah, so you might
Mum
have
wants to go on a cruise.
if there was a health emergency or something I'm hopeful that we don't have to touch it. So you just want to consider that kind of stuff. Like if it's wishful but you don't actually want them to own it, it could still be invested in your name.
Yeah, for sure.
So think about what the goal or the purpose is for it, how long you're going to have it, and then you could potentially set up a minor's account which is in trust for, to be in your tax file number.
Yeah, great.
And then become theirs.
We can share a link in the show notes to this guide that's how to invest for kids. And it talks about the 3 different options that Gem's just talked about, like parents, in trust for, and family trust I mentioned towards the end there. I'd say, just as a general gist, if you think you're going to have more than 20 or 30 grand to invest for your children.
I thought you were going to say kids.
Oh, 20 or 30 kids. It's going to be a Netflix documentary coming out soon on this family. No, but if you think you're going to have 20 or 30 grand, I would say maybe you start to think about what are the other options. What are those family trust things that people talk about? What are those investment bonds people talk about?
And you could chat to your accountant. You want somebody to help you decide. You can always change, right? That's you can change structures, but it can be costly. So if you've got a plan and you are very committed to it, and it's not just, we're chucking in $5 here and there. If you've got a bit of a clear plan, then you want to say to maybe an accountant, hey, I think within 5 years we'd be here. Do you think we should start this structure now? Should I keep going? You can just get as much information you have on hand to make an informed decision.
Yeah, I like it.
It's key.
Yeah, so that's a great question by Daddy New Money. Compound Investor, great question on Mortgagee. Great bit of feedback on Mortgagee Sales. If you're in the market for a bit of a discount on a property, maybe you can find one on realestate.com.au following Compound Investor /Jace's strategy. Crispy Bacon, you asked a question about being 35 years old or thereabouts and how to begin investing. So many great ways. I think the consensus amongst us was maybe aim for a house, but start to put those training wheels on immediately, start using some of the platforms that even we've mentioned in the show to start buying and selling shares. That relates also to Daddy New Money's last question, which was about just investing for kids. It's quite interesting this because I recently caught up with a friend of the show called Claude Walker. He's an investor based out of Sydney. And Claude said that he made a promise to his son when he was born that he would buy him a Google share for his birthday every year. Now, Google shares, for those that aren't familiar, rose to $2,000 a share. So I think it got a bit onerous towards the end. But
it's a big commitment.
Yeah, but I think it eventually had a breakup. Like it broke from like 10 shares into, from 1 share into 10. So the actual price came down so you could keep buying them. But you might be able to have something that you do for fun with your kids or some type of ritual that you commit to with them. Because like grandparents, if you're listening to this, your kids don't care about BHP and Telstra. As much as they might like the dollar symbols, they might not like the actual company. So find a way to connect with them as well and maybe make it a bit of fun. Like I'm thinking of buying Costco shares for Charlie because that's where we got his Huggies nappies from, right? Turns out Costco's the 13th biggest company in the world. Who would have thought?
Really? We have a hard and fast rule in my household, which we've had since like the kids were born, that 50% of the money that flows into their life has to go into their share fund. So if it's like birthday money, whatever, because I'm like, you're not going to remember this plastic junk that you got as presents. So yeah, like if they do bottles, cans, recycling or whatever they get gifted, money, 50% has to go in.
Yeah,
and
that's
I remember
great.
Max was my son. He was like 5 or 6 and he got this white box for like it was a present. He was unwrapping it and he like lifted it up to his ear and shook it and he goes, I hope it's not shares. So they're like, as they get older, they're starting to realise the concept of it. But at Christmas, they actually had a fight over who put more money of their leftover Christmas money into shares. And I was like, this is the proud mama moment. Like, I'm actually happy they're fighting.
That's great. So you can bring rituals like that into your life, which I think is wonderful, to be honest. Because you can give your kids an education at the same time and make it fun.
But their education around money is the most important thing. You don't have to put your oxygen mask on first, get your own money sorted, make sure you're investing for you. You don't have to be putting money away for them. Get yourself sorted. Your conversation with them, talking to them about the value of money, why we prioritize this over that, all those little everyday conversations that you think aren't making a difference are going to make the biggest difference rather than just handing them money.
Now, another friend of the show, Tash Invest, who we've had on a few times, she said the biggest thing her parents did for her was talk about money. Yeah. Not say, hey, Tash, what are you doing with your money? But more just talk at the dinner table, just had a conversation.
And about what they're doing and bills and being in the supermarket. Just talk. It makes a huge difference. And talking about it from a really, this is like a whole different episode, but from a really like kind everyday perspective, not like, no, we can't afford that, which I still have to catch myself stop saying from the kids because you just want to shut them down when they like constantly ask for stuff. But just from no, we're prioritizing, or remember we just went to Time Zone and spent $1 million. Like,
on something
just about prioritizing and like all that kind of stuff. So there's so much value that you can do for kids that doesn't have to be investing or saving for them.
Porque non las dos. Your question about offsets or mortgages is about goal setting, actually. It's not about the ETFs or the property or this or that. It's actually about what do you want? Because from that, you'll have a strategy that flows out. Bill breaking. Is it possible to break up all your bills? Not all of them, but some of them you can pay in advance and you can get a mighty fine discount. Have that float that we talked about. Consider if maybe some of the government bills, they don't tend to put extra costs on you for paying monthly or yearly, so you can maybe manage those a bit better. But the ones that are like subscriptions, they do charge a bit more if you pay monthly. So wiggle that around a bit. Final thing we'll call out is that you can check out the link in your podcast player to go and have a look at Gemma's book on pre-sale. I did not know this. This is news to me. Does it have a cover?
It doesn't. The cover will go out, I think they said in the next week, but like I just Googled the name because I was like having a freak out. I was like, oh, I'm just going to double check this, no, triple check, and that nobody's used this name because it's been for so long that this has been in the works. And I was like, oh, damn, there is a book called this. And it was my listing and I didn't even know.
Oh.
And it says, so it's on Booktopia and Amazon.
Can you tell us the name of the book?
It's called The Money Reset.
The Money Reset. I'm going to go Googling now.
So it's like 12 steps that is just to reset your money. So it's for anyone that's kind of lost a bit of direction or they've had a major life shift and they're like, I just need to get back on track, like just reset completely. So I'm going to work on the sales pitch from that so I can explain it better. I think Wiley, the publishing marketing team, are going to be like, Gemma, stop talking until we get the blurb.
That's great. So it is cover coming soon, The Money Reset. Take control of your money and your life by Gemma Mitchell. That's so good, Gem. Well done. And kudos to you for being in the Daily Telegraph as well. That's awesome. That's wonderful.
And please remember to be kind to me because I don't take a lot of bad things.
Let's reassure Gemma of how amazing she is and so good. Finally, for next week or the week after, send us your collectibles. I'm in the market for collectibles. I love a bit of
I'd like a hot tip on the next thing.
Yeah.
Maybe I buy something for the kids that's not shares.
Yes.
They can actually
they can see what a real life investment might look like. So that's kind of cool too.
We will take financial advice from the community.
Yes, send us your tips.
Don't take financial advice from us.
No stock tips, but definitely collectibles tips. So Gemma Mitchell, absolute pleasure. Thank you for joining me.
See you next week.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.